Hello, everybody. In Module 5, I discussed real effects of accounting disclosures. Module 5 has 6 lessons. Today, we focus on Lesson 6, real effects of mark-to-market accounting. Mark-to-market accounting or fair value accounting is a fundamentally important accounting issue. Proponents of mark-to-market accounting, they often claim that mark-to-market accounting or fair value accounting is better because it provides more information. This logic might be correct for a single-person decision-making setting without real effects. In this case, more information cannot hurt. Even if the information is completely useless, you can always ignore this information. However, we have already seen this module that when you consider real effects, more information may exacerbate distortions of real decisions. So mark-to-market accounting is not necessarily better. The discussion is based on Planning et al. 2008 JAR paper. The paper shows that when prices are distorted because of strategic complementarities, which we're going to discuss a little bit later in this lesson, mark-to-market accounting is going to exacerbate such distortion, and so has adverse real effects. Now let's look at the setup of the model. There's a continuum of financial institutions. They're exactly identical. There are 3 dates, 0, 1, 2, typical real effect setting. At day 0, financial institutions make real decisions. At day 1, price is determined. And at day 2, all the uncertainties are realized. At day 0, each financial institution holds a loan portfolio with some exogenous value of V0. Portfolio is going to generate some future cash flow of V. The only uncertainty is when V is going to be realized. The amount of V is deterministic for tractability reasons. V could be realized at date 1 or 2. The probability that V is realized at date 2 is D, which is also the duration of the portfolio. The longer the duration, the higher the probability that V is realized at date 2. Financial institution makes a real decision at day 0, whether or not to securitize the loan. Financial institution can choose to securitize the loan and sell the loan at date 1, or they can choose to hold the loan portfolio on their balance sheets. If the loan portfolio is sold, the selling price is delta V minus gamma S. First term, delta V. Delta is between 0 and 1, so it represents a discount from the loan portfolio's cash flow V. Captures the assumption that the buyer of the loan portfolio is not the best user of the portfolio. The second term is the usual price decreasing supply term. The supply S is the fraction of financial institutions that choose to sell. Gamma is a proxy for illiquidity. The higher gamma is, the lower price is, conditional on the same fraction of financial institutions that choose to sell. Conditional S, the expected proceeds from selling, is delta V minus gamma times S over 2. That's because the paper assumes that if S fraction of financial institutions chooses to sell, your position in the queue is uniformly distributed between 0 and S. The financial institution's objective is to choose whatever real decision to maximize expected period 1 accounting earnings. The amount of earnings, of course, depends on the accounting regime. We're going to consider 2 regimes, mark-to-market and historical cost. Let's first look at the mark-to-market regime. In this regime, the expected date 1 accounting earnings, if the financial institution chooses to hold the portfolio, is the following. So the 2 terms, the first term, with 1 minus D, the portfolio is going to return V at date 1. In this case, you have to record your portfolio as value V. So that's 1 minus D times V term. The second term, with probability D, the portfolio is not going to return V at date 1. And in this case, if you hold the portfolio, because of the accounting, you have to mark the value of the portfolio to the market price. And in this case, the market price is delta V minus gamma S. If you choose to securitize the portfolio, expected date 1 accounting earnings would just be the expected selling price, delta V minus gamma times S over 2. The financial institution is going to hold the portfolio if the expected payoff from holding the portfolio is larger. And this one is trivially satisfied if the duration is smaller than 1/2. We have the first results. For short duration portfolio, all financial institutions prefer to hold, and mark-to-market achieves the first best, which means that for short duration portfolio, there is no trade-offs. So now, we focus on long duration portfolios. But first, let's look at historical cost regime. Under the historical cost regime, the expected date 1 accounting earnings if holding the portfolio is as follows. The only difference between this regime and the market-to-market regime is, with probability D, the portfolio is not going to return V at date 1. For mark-to-markets, you have to market to market. For historical costs, you can mark that at the original value V0. And if you choose to securitize the portfolio, then it doesn't really matter which accounting regime you're talking about. Your payoff would be the expected selling price. And if we assume that delta is bigger than 1 minus D, then what we have is the financial institution is going to sell when the payoff from selling is larger, which holds when S is small. The fraction of financial institutions that choose to sell is going to be small. So here you can see the difference between historical cost and mark-to-markets. In the mark-to-market regime, if S is big, then you choose to sell. In historical cost regime, if S is big, you choose to hold. And the reason is because the different accounting treatment. In mark-to-markets, if S is big, you have to mark your portfolio to the market value. And if S is big, the value will be small. You better sell and hope you sell ahead of others, so you get a better price. In historical regime, when S is big, if you choose to sell, you have a lower value. So you would prefer recording at historical cost, which is higher. So now let's look at equilibrium in both regimes. In the historical regime, we already know that the payoff from holding and the payoff from selling, which means that in a historical regime, if you compare the payoffs, then all the financial institutions is going to hold when V is smaller than some V star number. And they're going to sell when V is bigger than some V upper star number. And in between, they're going to randomize. When V is sufficiently large, selling is better because in this case, selling, you're going to recognize the high fair value instead of the low historical cost value, even if everybody else wants to hold. When V is sufficiently small, holding is better because if you sell, you're going to record a very low value, even if everybody else chooses to sell. When V is in the middle, there's no pure strategy. If everybody else wants to sell, the price would be very low. You want to hold. If everybody else wants to hold, you may actually want to sell because the selling price would actually not be low. So there will be mixed strategy. In a mark-to-market regime, we can also get the payoff from holding and the payoff from selling. Compare them, we can see that when V is sufficiently larger than some V hat, all the financial institutions are going to hold. When V is smaller than V hat, however, there will be multiple equilibrium. The intuition is as follows. When V is sufficiently large, holding is better, even if everybody else sells. Because when V is sufficiently large, even if you hold and everybody else sells, the price is still sufficiently large relative to selling. But when V is sufficiently small, then strategies become what we call strategic complementarities. Strategic complementarities means that if everybody else is doing this, you better doing this too. So if everybody else sells, you want to sell. Because if you hold, the fair value would be very low. You would rather sell and hope you sell before everybody else. And if everybody else holds, you want to hold. Because if you sell, the value would be not very high. If everybody else chooses to hold, then the fair market value is still reasonably good. So for this multiple equilibrium, how do we select equilibrium? There is a technique to select unique equilibrium in a mark-to-market case, which is what we call the global games technique. So the trick is multiple equilibria exists under this strategic complementarity because V is common knowledge. So if one sees V and one conjectures that others are doing one thing, they would want to do one thing. But if they conjecture others want to do another thing, they want to do another thing. But if we add a little bit noise on V, then we can get to the unique equilibrium. Because in this case, you would not observe V perfectly. You know, others would not observe V perfectly. So you cannot perfectly conjecture what their strategy is. So in this case, we just let each financial institution observe some noisy private signal about V. And in this case, we're going to consider a threshold equilibrium. You're going to hold if your private signal is bigger than some threshold and sell otherwise. And this is quite intuitive. If you see a lower signal, it means that V is likely to be low. And so others, they're also likely to observe a low signal. So others are likely to sell. So you would be better off selling. So once we apply this global games technique and we conject the threshold equilibrium, then the financial institution that observes the private signal that is exactly equal to the threshold will be indifferent between selling and holding. Using this indifference condition, we can solve for the threshold, X star, which in this case, it turns out to be V hat over 2. And that solves the equilibrium. Now we're just going to compare regimes. The first observation is that extreme price values are more likely under mark-to-market. And intuition is under mark-to-market regime, selling is more likely to occur when V is low, which further pushes down the price. In a historical cost regime, selling is more likely when V is high. So that stabilizes the prices. In mark-to-market regime, when V is very high, nobody sells. And so you will have high price value. And when V is low, everybody sells. So you're going to see very low price value. In historical regime, you don't see those extreme values. And we can look at welfare. Welfare is defined as the negative of the aggregate expected loss to the financial institutions. And we can see that fair value accounting leads to more losses for assets with more downside risk. And that comes from the previous point. Assets with more downside risk, they're more likely to have low values of V. When we have more low values of V, financial institutions are going to sell more under mark-to-market or fair value. That results in more losses. Also, historical cost is going to lead to less losses if the duration is higher. And the reason is because historical cost regime trades are less sensitive to duration because of inertia of the historical cost. However, trades are highly sensitive to duration under mark-to-markets. And higher duration exacerbates such inefficiency because higher duration makes everybody more willing to sell, in particular when the value is low. So the implication is that fair value should be applied to short-term assets with shorter duration. The historical cost applied to long-term assets. This seems to be consistent with US GAAP. When fair value is applied to investments held for short-term, but for investment held for long-term, we don't do fair value. In addition, historical cost leads to less losses if illiquidity is higher. And this is also very intuitive. More illiquid markets exacerbates the strategic complementarity, exacerbates the coordination failure under fair value or mark-to-markets. But it deters the sale for historical cost. When the market is very illiquid, the selling price is very low, and you have less incentive to sell. The implication is that because banks, they hold mainly illiquid assets, that's why they don't like fair value accounting, because historical cost leads to less losses. To conclude, fair value accounting exacerbates the selling of loans when loan value is low and should not be sold. And that results in inefficiency. But historical cost accounting is not a panacea. It has its own inefficiencies because it can induce selling during good times because of cherry-picking behavior. Firms want to realize the gain that can increase accounting earnings when V is high, instead of recording that at historical cost. And so there is a trade-off between those two accounting regimes. Fair value accounting is more detrimental when assets have more downside risk, have longer duration, and are more illiquid. Those are characteristics of the assets that banks hold, which is why banks oppose fair value accounting the most. To test your understanding of this lesson, you can take a review quiz of this lesson found on the link on the slides. Thank you very much.